It is the evening of January 15th, 2026. The markets have just closed. The noise has quieted. But if you're watching the precious metals sector right now, you can feel it. That thick, heavy air before the storm breaks. If you looked at your screen this morning, you saw a disaster. At exactly 9:45 a.m. Eastern, silver got hammered. We saw a brutal high-volume dump that smashed the price down 4% in minutes. It was the kind of move designed to trigger stop losses. It was the kind of move that shakes out the weak hands and makes retail traders panic sell their positions. The mainstream financial media is already running the headlines. They are calling it a technical correction. They are calling it profit-taking. They want you to believe that the silver bull is tired. But they are lying, and I can prove it. Because while the spot price of silver bled out 4% this morning, the miners, the companies that actually dig this metal out of the ground, barely flinched. The silver miners ETF opened down 1.4%, and by midday, it had recovered almost all of it. Let me say that again because it is the most important signal in finance right now. The commodity crashed, the equities held. In my 12 years of trading institutional capital, this is what we call a divergence signal. When the underlying asset falls, but the related stocks refuse to go down, the market is screaming a secret at you. It is telling you that the selling in the metal is fake, but the buying in the stocks is real. It tells you that the smart money, the whales, the family offices, the insiders, are not selling. They are standing beneath the market with a bucket, catching every single share you panic sell. They are defending the floor. Why would they do that? Why would they buy miners aggressively while silver is crashing? Because they have a calendar, and they know exactly what happens in less than 12 hours. Right now, as you watch this, we are staring down the barrel of January 16th, the third Friday of the month, monthly options. Expiration, OPEX. For the uninitiated, tomorrow is the most dangerous day of the quarter for the big banks. It is the day where billions of dollars in call options, bets that silver will go up, either print massive profits for the public or expire worthless for the banks. The banks are currently holding a massive short position. They are on the hook for billions if silver closes the week above $90. So what do we see today? We saw a desperate, coordinated attempt to pin the price below $91. They smashed the metal to save their balance sheets. But the miners are telling us the suppression is about to fail. The mining stocks are acting like a beach ball held underwater. The pressure is building. The energy is storing up. And tomorrow afternoon, when the options expiration deadline passes, the hands holding that ball underwater are going to let go. Bridge phrase, but to understand just how violent the snapback is going to be, and why these mining stocks are mathematically spring-loaded to explode the moment the suppression ends, we have to look at a concept called operating leverage. Because right now, these companies are trading as if silver were still $30, and the math is about to correct itself with a vengeance. To understand why the miners are pinned to the floor while silver is trying to fly, you have to stop thinking like an investor. You have to stop looking at earnings reports, geological surveys, or dividend yields. To understand the price action of the last 24 hours, you have to think like a risk manager at a bullion bank. We are currently less than 12 hours away from the open of trading on Friday, January 16th. This is not just another Friday. This is the monthly options expiration. And for the institutional short sellers, this is the most dangerous day of the year. Here is the situation on the board. Over the last 3 months, as silver climbed from $70 to $91, retail traders and hedge funds bought millions of call options. These are bets that the price will go higher. Specifically, there's a massive wall of open interest at the $90 and $95 strike prices. When you buy a call option, someone has to sell it to you. That someone is usually a market maker or a bank. If silver closes tomorrow at $89, those options expire worthless. The bank keeps your premium. They pop the champagne. But if silver closes at 92 or 95, those options are in the money. The bank is on the hook to deliver millions of ounces of silver at a price far below the market rate. This creates a liability of billions of dollars. It is a financial bomb ticking down to zero. This brings us to the mechanism they are using to suppress the price. It's called pinning the strike. They tell you that markets are efficient. They tell you that price is discovered by supply and demand. The reality is, during OPEX week, price is engineered. The banks are currently trapped in a negative gamma position. I'll explain that simply. It means that as the price of silver goes up, their losses accelerate exponentially. If silver breaks $92, they are forced, by their own risk models, to buy futures contracts to hedge their exposure. But buying futures drives the price up further, which forces them to buy more futures. This is the gamma squeeze. It is the feedback loop that destroys hedge funds. So how do they stop it? They have to prevent the spark from lighting the fuse. They have to keep the price of silver physically pinned below 92 until the closing bell rings tomorrow afternoon. They are selling paper contracts with one hand to cap the silver price, and they are shorting the mining stocks with the other hand to kill the sentiment. It is like holding a beach ball underwater. It takes a massive amount of energy. You have to push down constantly. Your muscles burn. You are fighting physics. The moment you lose focus, or the moment you run out of energy, that ball doesn't just float up. It rockets out of the water. That is what we are watching right now. The relative strength in the miners today, the fact that they refuse to crash when silver dumped, is the first sign that the banks are losing their grip on the beach ball. They pushed it down, and the market pushed it right back up. The beach ball wants to fly. Now that you understand why they are suppressing the price to survive tomorrow, we need to talk about what happens when the suppression fails. We need to talk about operating leverage. This is the single most explosive concept in finance, and yet 99% of retail investors ignore it because they are too busy looking at the spot price. Operating leverage is the reason why a 10% move in silver can create a 100% move in a mining stock. Let me break this down with a metaphor that cuts through the jargon. Imagine you own a lemonade stand. It costs you 1 oysters to make a cup of lemonade. That covers the lemons, the sugar, the cup, and your time. If you sell that cup for $1.10, you make a 10-cent profit. Your margin is razor thin. You are barely surviving. Now, imagine there's a heat wave. The demand for lemonade explodes. You raise your price to $2 at Azores. But here is the magic. Your costs did not change. Lemons still cost the same. Sugar still costs the same. It still costs you $1 to make the cup. So now you are making $1 in profit per cup. Let's look at the math. The price of lemonade went up 81% from $1.10 to $2.00. But your profit went up 900% from 10 cents to $1.00. This is operating leverage. The profit expanded 10 times faster than the price of the product. Now, let's apply this to the silver miners because the numbers are even crazier. For the last decade, the average all-in sustaining cost, AISC, for a decent silver miner has been around $25 to $30 per ounce. This is the break-even line. It includes digging, refining, taxes, royalties, and administrative costs. When silver was trading at $30, which it was for a long time, these companies were dead money. Price, $30, minus cost, $30, equals zero profit. Investors hated them. Wall Street ignored them. They were zombie companies. But look at where we are today. Silver is trading at $91. Has the cost of mining tripled? No, diesel is up a bit. Labor is up a bit. Let's be generous and say costs have risen to $35 per ounce due to inflation. Let's do the math on the margins. Old reality, price $35, cost $30 or $5, profit per ounce. New reality, price $91, cost $35, $56 profit per ounce. Do you see what just happened? The price of silver went up 160% from $35 to $91, but the profit per ounce went up 1,220% from $5 to $56. Here is the anomaly. Here is the glitch. The stock prices have not moved. The mining ETFs, the CL and CLJ, are still trading at levels we saw when silver was $40. They are priced as if the companies are making $10 an ounce, not $56 an ounce. Why? Because the market doesn't believe the $91 price is real yet. The market has been conditioned by 10 years of bear markets to believe that every rally will fail. Investors are suffering from PTSD. They are scared to buy. And the banks are using that fear to keep the short position open. But math always wins in the end. Right now, you have mining companies that are trading at 3x or 4x free cash flow. Compare that to the S&P 500. NVIDIA trades at 40x earnings. Tesla trades at 60x earnings. The average tech stock trades at 25x earnings. And here you have silver miners, companies with zero debt, holding a strategic asset that is running out, trading at single-digit multiples. This is not a value trade. This is a mispricing of catastrophic proportions. We are looking at the deepest value dislocation in the entire financial markets. The spring is compressed so tight that when it snaps, it won't just double. It has the mathematical capacity to 5x or 10x just to get back to fair value. And it gets better. Because the stocks haven't moved, the short interest in these names has piled up. Hedge funds are shorting these stocks, betting they will fall back to the $30 reality. They are betting on mean reversion. But if silver holds $91, there is no mean reversion. There's only margin expansion. When these companies report earnings next month, they are going to show cash flow numbers that will blow the analysts' minds. They will announce massive dividends. They will announce stock buybacks. And when that news hits the wire, the shorts will be trapped. They will have to cover their positions. They will have to buy the stock. But who are they going to buy it from? The weak hands have already sold. The only people left holding these stocks are the diehard believers in the smart money that started accumulating today. This creates a liquidity vacuum to the upside. High demand, shorts covering, plus low supply, no sellers. It's a parabolic move. This is exactly what we saw in the dark pool data this morning, which I will explain in the next section. Because while you were watching the ticker tape, the institutions were doing something very different in the private exchanges. Here's the continuation of part 2, sections 3 and 4 of the script. Now, I want to show you the smoking gun. The piece of data that the mainstream media never talks about because they don't have access to it. While retail traders were panic selling their mining stocks this morning because they saw silver drop 4%, something very strange was happening in the dark pools. For those who don't know, dark pools are private exchanges used by institutional investors, hedge funds, banks, pension funds, to trade massive blocks of stock without moving the public market price immediately. At 9:45 a.m., the exact moment the silver price crashed, we saw a massive spike in block trade volume on the SIL and SILJ ETFs. Usually, when price drops on high volume, it means everyone is rushing to the exit. But look at the price action of the miners after the spike. They didn't collapse. They V-shaped. They bounced instantly. What does that tell you? It tells you that the volume wasn't selling pressure. It was a limit order. A massive institutional buyer was sitting right there, mouth open, absorbing every single share that retail investors threw away. They treated the crash as a liquidity event. They needed you to panic so they could fill their order without spiking the price 10%. This is called accumulation distribution. The smart money distributes fear to the public by crashing the metal so they can accumulate the equity, the mining stocks, at a discount. They are buying the tickets to the show right before the doors open, and the show starts tomorrow. But wait, the skeptics say. If the miners are so great, why haven't they moved yet? Why are they lagging? This is the final piece of the puzzle. And it is the most bullish signal of all. The lag is not a bug, it is a feature. We have seen this movie before. We just need to rewind the tape to late 2010. Back then, we were in the middle of a historic silver bull run. Silver was tearing higher, breaking $20, then $25. But for months, the mining stocks did nothing. They went sideways. They frustrated everyone. Investors were screaming, "Why aren't these stocks moving?" And then the rubber band snapped. In early 2011, the mining sector woke up. In a matter of weeks, the mining stocks exploded. They didn't just go up, they went vertical. Some junior miners did 300% to 500% in 2 months. They compressed a year's worth of gains into 8 weeks. This is the catch-up trade, and the market is inefficient. It takes time for the big generalist funds, the ones who manage trillions of dollars, to rotate into a tiny sector like silver miners. They are slow. They are like battleships turning around. But once they turn, the wave they create lifts everything. We are currently in the 2010 lag phase. Silver has moved. The miners have stayed flat. The valuation gap between the metal and the stocks is now wider than it was in 2011. It is wider than it was in 1980. We are looking at the most compressed spring in the history of the sector. The OPEX suppression tomorrow is the final weight holding that spring down. Once the options expire, the artificial selling pressure vanishes, and the only thing left is the math. Price, $91. Cost, $35. Final arms explosion. We have arrived at the conclusion. If you have stayed with me through this deep dive, you now possess the one thing that Wall Street desperately tries to keep for itself: context. You understand that the crash to silver this morning was a manufactured stop-loss raid. designed to protect the banks from tomorrow, else options expiration. You understand that the operating leverage of the miners means their profits have exploded by 1,000%, even though their stock prices are flat. And you understand that the smart money use the chaos today to fill their bags in the dark pools. The evidence is forensic. It is undeniable. We are looking at a market that is fundamentally broken. On one side, you have the paper reality, a manipulated ticker symbol pinned below 92 to save a few banks from insolvency. On the other side, you have the mathematical reality. Companies printing cash flow at levels we haven't seen since the 1980s. The gap between these two realities is the profit zone. And tomorrow afternoon, when the closing bell rings and the options contracts expire, that gap begins to close. So, what should you do? How do you play the next 72 hours? First, do not feed the beast. If you are holding quality mining stocks, do not let the volatility shake you out. The banks need your shares. They need liquidity to cover their shorts. If you sell now, you're donating your potential wealth to the very entities betting against you. Check your stop losses, make sure they aren't too tight, and hold the line. Second, watch the Friday close. Tomorrow is the battlefield. Ignore the morning noise. Ignore the midday chop. The only thing that matters is the price at 4 p.m. Eastern. If silver closes above $91, and if the mining ETFs, SIL, SILJ, stay green, the suppression has failed. The short sellers are trapped. That is your signal. Third, prepare for the Monday gap. The history of the catch-up trade tells us that the biggest moves happen when the market is closed. When the suppression lifts on Friday night, the repricing often happens over the weekend. We could wake up Monday morning to gap ups of 10%, 15%, or 20% in these stocks. If you are waiting for a safe entry on Monday, you might find yourself chasing a train that has already left the station. The time to position is before the event, not after. I want to leave you with this. The market is designed to be an expensive place to find out who you are. It is designed to transfer money from the impatient to the patient, from the fearful to the disciplined, from those who watch the screen to those who do the math. Right now, the screen is lying to you. It says these companies are worthless, but the math says they are gold mines, literally and figuratively. In a world of deception, the most rebellious act you can commit is to simply hold on to the truth. The price is an opinion. The cash flow is a fact. Do not let their opinion steal your fact. The mainstream media will tell you tomorrow is just another volatile day. They will miss the signal. We won't. If you want to navigate this transition without getting shaken out, if you want to stand with the few who see the mechanism behind the curtain, then you know what to do. Join us, subscribe, and turn on notifications. Because the next time I speak to you, the buy button might be a lot more expensive. Stay safe, watch the close, and I'll see you on the other side.